Okay, so the lack of risk management. This topic is talked about a lot more than the other two that we've covered in the previous videos, as risk management should be at the core of your trading and investing process. And it's pretty obvious to everyone that it's better to have a process to lose less money than to lose more money. But today, again, I want to focus on the emotional aspects and the compounding effects of the lack of risk management. The way it leads to your emotional capital being depleted and ultimately to increased financial harm. Basically, at the core of this is the fact that overly charged emotions and clear thinking don't go together. Risk management is about accepting failure and embracing losses, and that's not something that comes naturally. If you've been trading financial markets long enough, that's probably something that you've quickly learned, but yet it is still hard to apply because it's so counterintuitive. Stanley Druckenmiller, George Soros' partner, said of Soros, who's arguably the best or one of the best trader of his generation, that his greatest strength and reason for success was his ability to take losses. So I'm going to quote him. Soros is also the best loss taker I've ever seen. He doesn't care whether he wins or loses on a trade. If a trade doesn't work, he's confident enough about his ability to win on other trades that he can easily walk away from the position. It is crucial that you have this ability to quickly walk away from the trades that don't work. So let's work with an example here. So let's say this is the trade you want to enter, and you've looked at the trade long enough, you know all the parameters, and you get all the ins and outs, and this is your stop loss here. You're going to enter here, and this is your stop loss here. And let's say for this example that if your stop is hit, you're going to lose $500. Minus $500. So I take $500 for this example, but it could be like $1,000, $10,000, depending on your account size, or let's say $10 million if you're George Soros. But I believe that everyone should have a number before they enter the trade. So let's say the trade starts going against you, like this. We go down, and pretty quickly we hit our stop loss. But rather than take the stop loss, you start to rationalize and find reasons why not to take it, and you look for clues that it's about to turn around, and if you take the loss now, you're going to miss out on the big move back up, going back to the fear of missing out. And even though you carefully thought out that this here would be the point where you would be wrong on that trade, you still decide against doing it, even though you're under pressure, and it's probably not a good time to rethink this whole situation that before you enter the trade you had carefully thought out. But now that you're under pressure, you're deciding to reconsider. So that's your first sign of trouble. You may even compound the problem and like average down or double down, thinking that, well, I'm going to reduce my average price, so this is going to be better, and I'm going to be back into the money quicker. Just as an aside, you're not in this to be back in the money, you're in this to make money. So the idea of getting back to even is like also one of the worst things you can be thinking about. So, and why are you doing this? You're doing this because this is failure. This is pain. This causes you pain. And because maybe you feel like you can't afford to lose that money. And naturally, as a human being, you don't want to take pain. You have a hard time facing failure, and you don't want to take pain. So this is pain. You don't want to take the pain. And so, of course, what happens next? We go further down, of course, as always the case in cases like this. And now let's say we're here, and we're at minus 1,000. So what is this at this point? it's double the failure and it's double the pain. So you even less than when we were at this stage, you want to take the pain now. It's even harder to take the loss here, to cut the trade here, because this is even more pain and facing even more failure. So your ability to take the loss is reduced from what it was when we were over here. So, and as these continues to go down, and we go further down, your ability to deal with this situation decreases. And eventually there's the risk that you lose control of the situation, and this turns into a big loss. It turns like what would have been like a small, insignificant loss into, with the help of leverage sometimes, into a big damaging loss. Like we go here, and then to here, and on and on and on. And as this is happening, your ability to deal with the situation is doing this. Your ability to make rational decisions is doing this. The emotional toll that this takes on you is immense. And I truly believe that your emotional capital is more important than your financial capital when it comes down to making money in the market. So while you're in this, and given the intense pain, all of your attention is focused on this whole process. You're watching every tick. You can't pay attention to anything else. And because the emotional state that you're in and the pain, you've completely lost your ability to pursue like other opportunities that might be around. If I put your hand over like a flame and I ask you to solve like a simple math problem, you won't be able to do it because all your brain energy will be focused on the pain that's going through your hand from the flame. And also, again, if I put your hand over a flame and I ask you to describe what's going on behind me, you won't be able to do it because all your brain will be focused on the pain that's going through your hand. And there lies the really disastrous compounding side effect of all this process. It's the huge opportunity cost. Because while you're stuck on that trade, it's bleeding money, while you're not pursuing other potentially great opportunities that may be presenting themselves. Also, you're likely to make mistakes on other trades, or you may like cut a profit prematurely on a good trade to sort of finance the losing trade, and make or enter other bad trades. So you're increasingly losing money here, but also you've lost your ability to make money here. So it makes no sense to be doing this. It makes no sense at all. Regardless of what this trade does, or if it comes back or not, it makes no sense. Again, I'm going to quote one of the best traders of his generation, Paul Tudor Jones. He makes it very simple. He says, I'm going to quote him, if I have a positions going against me, I get right out. If you have a losing position that is making you uncomfortable, the solution is very simple, get out. And the reason he's saying that is because he's acutely aware of this process, of what goes on when this is happening, and the incredibly damaging effect on your ability to function as a trader or even as an investor. So you cannot let this happen. You just can't. Again, regardless of what this trade is doing, even if it's coming back, you cannot do this. As a trader, you cannot do this. You have to have a process and some sort of automation in place to deal with these situations, because even if you're one of the best, you're going to be wrong often. That's just the nature of the business. That's the nature of trading. And related to this is also something I believe is important to consider, and that's decision fatigue. I believe that your reserve of brain power is not unlimited every given day, and that there are a lot of variables that go into that: sleep, food, other events in your life. But there's only so many optimal decisions that you can take on any given day. So you have to have some automation or process in place that when the crucial decision comes around, well, then you have all your ability to focus on that decision and make the right decision. So Tim Ferriss has a great podcast on this subject, decision fatigue and automation. So I'll put the link in the show description. And I really recommend that you listen to that podcast. And also, if you have a strong process and a well-defined risk management process, well, then you end up having a lot more confidence in your trading, because you have that system in place and you know exactly what you will do and what will happen if a trade goes against you. That you know that there will be no paralysis, or there will be no fear, and in turn you have a lot more confidence, and that confidence allows you to do more and pursue more opportunities to make money in the market. And that's the positive compounding side effect of having a strong risk management process and embracing small losses. And that's why it's something that's really crucial if you want to be successful and like expand what you do and expand your trading and really grow into your ability to do more things in the markets. So this concludes this series of 3 videos on how emotions affect your trading and investing and get you sometime in trouble. Again, the reason I'm able to talk about this and to share this with you is that I was myself affected by these 3 issues at one point or another during my career, and that when I was able to recognize them and work on them, that I was able to move to a much higher level. So success in trading is applying some very simple rules that are often hard to apply because they're so counterintuitive. The difficulty in trading is that often you're not trading against the market, but you're trading against yourself. So again, I truly believe that to be successful in the market, you have to tackle these issues and you have to rid yourself of these bias and others, but I think these 3 biases are really crucial. So I hope you've enjoyed these videos and got some values out of them. Again, please don't hesitate to contact me with any questions or comments via Twitter. And again, thank you for watching.